Hello, with me today I have David Mirzai, energy analyst at SP Angel. Hi David, thanks for joining me.
Nice, thanks for having me.
Look, what should investors in oil companies look out for over the next 6 months? Is it all about the price of oil, or are there other triggers that are just as important for them to look out for?
No, I think if you look at the management teams within the oil and gas sector, they've become a lot more investor friendly, shall we say, in the last 10 years. Certainly they've demonstrated a lot better capital discipline than they did 10 years ago. And they've actually rewarded shareholders for these higher oil prices in terms of share buybacks and cash dividends. So I think that should be certainly the first thing that plays on investors' minds. I think looking back at how the sector or the sector's investment community has evolved over the last 5 or 10 years, given the ESG concerns about moving towards net zero, you've certainly seen capital outflows from the oil and gas sector. And therefore, I think any investor, when they look at, well, where should I invest? They should pay probably close attention to which companies have integrated solutions towards a net zero solution. Which companies are actually incorporating this into their strategies. Because although I don't think it will be as quick to get to net zero as a lot of people hope, it's certainly something which I think more investors will ask you to be mindful of.
So 2 companies I'm going to mention next have very developed ESG strategies. And I'm going to ask you, what's your favourite large cap oil stock? Is it BP or Shell, and why?
Well, I've spent most of my career as an E&P expert, certainly at the lower end. To me, the large caps, the IOCs, Shell and BP, are just dividend yields. And both of them will offer investors a 10% return, both in the form of cash dividends and buybacks this year. And both of them have transition plans in operation, which we say that they've somewhat pulled back on in terms of those ambitions or how quickly they reach those ESG ambitions in the last 12 months. So I suppose that the key difference between those 2 companies is when are we going to see some meaningful change in their strategy? Given that BP has recently lost its CEO, you'd be expecting a new BP CEO to come in and try to be as investor friendly at the outset. Therefore, I think on that basis alone, BP is probably what I would lean towards over the next few months ahead of those strategies in early 2024.
Okay. And are there any UK listed smaller oil companies you think have the potential to do well over the next 12 months?
Oh, certainly. And it depends on where the investor feels happy with the level of risk. Certainly, just like BP and Shell, there's a number of players in the UK listed markets that at the moment are producing oil. They're making huge benefit in terms of cash flow from the current oil prices, and they do pay double-digit returns in terms of cash dividends, share buybacks, everything from Harbour Energy to Union Jack Oil, and there's plenty of them in between in a range of jurisdictions. That, from my point of view, would be where, if you were looking for dividend yield, that's where you'd go to. Make sure you're happy with whatever country risk, whatever asset risk you take on. But those companies can pay seemingly strongly above what the market pays in terms of interest rates. As you move down the risk profile, if you're looking for more development type assets, so a slightly higher risk element, I suppose from our point of view, we've seen what's happened in the UK over the last 12-24 months, both with the initial increase in tax and then effectively the government yo-yoing on what their policy is, which does no one any good in the UK North Sea. Certainly we think with that kind of disjointed approach, we much prefer companies with an Africa-based focus. Africa is as a continent, has a deep need of localized energy and has very supportive governments. For example, you have the likes of Morocco, where you have two big gas development projects, one for Sound Energy, one for Chariot Oil, which have a lot of support from the markets at the moment and have a lot of support from the government. And that very much distinguishes it from a number of players, should we say, in the UK, as opposed to them. If we run down to the highest risk, but also the highest return end of the E&P spectrum, you have exploration and appraisal. Now, exploration and appraisal has been very much in the doldrums, certainly for the last 5 or 6 years, simply because there's been a lot of concern over stranded assets and would new discoveries actually make it into development, make it onto oil production before we ran out of a need for oil. And from that sense, if you want to back a winner in exploration and appraisal, you tend to go where the money is. And at the moment, the majors are investing a lot of money in Namibia, in Southern Africa, because they've made large discoveries of large oil resource bases in those areas. I think if you're looking for an exploration play, that's kind of where you want to put your money, where the big guys are putting their money, because those smaller guys will be the first people to feel that money feed through.
Are there any names, any companies in Namibia, that sort of area that you'd highlight?
Oh, well, you have a number of explorers in Namibia who are making good. In the UK, you'd have people like Global Petroleum and Tower Resources. In wider circles, you'd probably have someone like Eco Atlantic, which is participating in a number of wells offshore South Africa. Also, Africa Oil has an interest in some of the licenses being explored offshore Southern Africa and Namibia.
Okay, well, looking much further ahead, what do you expect the sector to look like in, say, 5 to 10 years' time? I mean, will the drive towards sustainability have had a dramatic effect on the industry? Do you expect the landscape to have changed much? Will it be unrecognisable?
There was a lot of hope, shall we say, back in 2020, that the transition would move a lot more quickly than it appears to be moving at the moment. That we would see a quicker substitution of low carbon energies for those higher carbon resources. That is not the way that the global system has evolved over the last few years. Certainly, if you look where interest rates are at the moment, it just feels far too expensive to accelerate that decarbonisation effort when there are so many other pressing requirements for that capital. I think then if you look at what we've seen recently, we've seen the two largest capitalised E&Ps or IOCs in the world, in Exxon and in Chevron, carry out two huge mega mergers. What they're looking for is they're looking to increase their direct exposure to large oil resource bases. Now, as two large US-based companies, they're probably also two of the most market savvy in the world, who have probably far more demanding investors than we see over in the UK. And they're picking their side. They're saying that they believe that those assets they're buying will not end up stranded, and that there will be a market for those assets into the medium term, and that will allow those assets to provide funding for their future cash flow, for their future dividends to shareholders. Now, it's not all negative. You know, you certainly are seeing a preference, shall we say, for advantaged assets. How would I describe advantaged assets? Assets which have a low carbon emissions intensity, assets that have low cost. Now, that may be because they are more gas prone than oil prone, or it may be because there's an integrated solution which allows some of those carbon emissions to be offset or to be removed from the system. And that seems to be where, if you want to invest in E&P, certainly be sure that whoever you're investing in has a solution which encompasses either lower costs, lower carbon emissions. but also, I mean, I'm an energy analyst for SP Angel, and I deal with a range of different activities, and that's one of the surprising things the last few years is that the energy space has just grown to absorb a number of the new technology, the new transition energies. And so certainly if the investor is looking for much longer term, slower, but IP growth, certainly look at some of the carbon capture and storage, someone like Synergia and AIM listed, or look at the green hydrogen plays, so someone like Atom Energy. But there's a number of different companies, right down to helium plays like Helium One, that all offer something else to the energy spectrum other than just oil and gas.
Fantastic. David Mirzai, energy analyst at SP Angel, thanks very much for joining me today.
Thanks, Carney.